This show is sponsored by Lightyear, a new straightforward platform offering a stocks and shares ISA with no account, subscription or custody fees. Lightyear's stocks and shares ISA will be 10 times cheaper than the average market provider over 10 years based on research conducted by Capital Economics. And its cash ISA offers easy access to the Bank of England base rate. Both accounts are flexible so you can withdraw and reinvest without affecting your annual limit. Capital is at risk and ISA rules apply. Other fees like foreign exchange fees may apply. Lightyear UK Limited is authorised and regulated by the Financial Conduct Authority.
Hello and welcome to episode 492 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good. It's a big week actually for Money to the Masses because during next week we will actually celebrate our 15th birthday. So Money to the Masses as an entity was created on the 4th of February 2010. So if you know the story, it was at the end of my paternity leave after my first daughter was born. I went back to work a little bit disillusioned and ended up creating or coming up with the idea for Money to the Masses. And the very first ever post was created back then. And it is still on the website. If you go and hunt deep enough and find it, there is one on there from those dates. So all that original content is there. So it's a big birthday for us. 15 years. Who would have thought it? And a lot has changed in those 15 years. So thank you to everybody who supported us along the way. And please do make sure that you write reviews about the shows, follow us on our Instagram profiles, YouTube, subscribe, all of those things. And do tell people about Money to the Masses, the website, the show, the podcast, YouTube, everything, because it means a lot. And it means that we hopefully can continue to be around in another 15 years' time.
And just as a bit of a visual thing for our listeners as well, you've got something that's slightly off screen, haven't you?
You'll also hear it. It's creeping. It's actually taken up the entire screen. You can hear the balloon. So there's a giant helium balloon which we brought in for me to take a photo so we could put it on socials next week. So do check out our socials next week. You'll see me grinning like a Cheshire cat with my massive happy birthday balloon. So do check that out. I'll put it back out of the way, otherwise you won't see me for the rest of this podcast. So for those just listening to the podcast, you probably would have heard a little bit of rustling there, so you still got to join in.
Okay, so many happy returns to Money to the Masses. Let's get on with this week's podcast, though. What have we got coming up on this week's show?
So the first piece is to do with behavioural biases. So they make us poor investors. It's what makes us human. But it does mean that it makes us not very good at investing. So for 80/20 investor members, I actually wrote an article of 14 of the key behavioural biases that you need to try and avoid or at least control. So I'm going to go through 7 of the main ones on this show. Now, the second piece on the show is in relation to crowdfunding. What is it? What are the potential returns and the risks? And I also look at some examples of past crowdfunding exercises that have been successful for some investors, but also some recent ones that have come to light that have been less successful. So it's very topical. And the final piece on the show, Andy, you are going to be looking at...
Well, it's financial planning week from the 27th of January to the 2nd of February. So I'm going to explain exactly what that is, why it's important, and also how people can get involved with that if they want to look at financial advice for the first time. We've got a couple of links that we can share with listeners. And also there's a tool at Money to the Masses that I think listeners will find really useful.
Great. And before we get on with the first piece, Andy, there's something I just want to mention. We talked about Vanguard Investor actually changing their fees on their self-invested ISA, pension and general investment accounts. So if you recall, they were going to be introducing a £4 a month minimum charge on those particular products from the end of January. And of course, there were lots of people up in arms about the new change. Well, the news broke this week that while the changes are still coming, they are now not going to be implemented until the 28th of February. So what it means is that you have another month in which you can look around and shop about for cheap alternatives, even if you still want to invest in Vanguard funds, if you want to try and avoid that new minimum fee. So we'll put links in the notes of this show and below the videos, so you can click on the heat maps that we created so you can actually shop around and see what might be a cheaper platform for you.
Okay, so let's get on with the first piece of the podcast then, Damien. It's an investing piece this week, and you've been looking at all the different types of biases that exist, especially in regards to people's investing decision.
Yeah, so we've touched upon this in past podcast episodes, but I thought it's about time we pulled a whole list of these together. Now, there is a really almost endless list of biases, but there are some key ones that everybody should try and avoid. And it's very difficult to avoid them. Now, as humans, we are naturally poor investors, and we're often tripped up by our own minds. And behavioural biases lead to irrational investment decisions and the market anomalies like crashes and bubbles that we see. So if we want to become better investors, we need to understand these biases and how they influence our decision making. Now, I'm going to go through a list of 7 of the main ones that I think are the most important, but I did do a full list of 14 of these for 80/20 investor members, so you can look at that full list and see the examples as well as the ways in which you can try and mitigate the biases from impacting your investment decisions if you take out a free trial of 80/20 investors. One of the main ones is loss aversion. So this is where investors tend to feel the pain of losses more strongly than the pleasure of equivalent gains. So this fear of loss can lead to them making impulsive decisions, especially when they see their investments decline in value. So an example of this can be where an investor might hold on to a losing stock or fund far longer than they should because they are afraid of realizing that loss, even if selling the stock and reinvesting the proceeds in a more promising opportunity would be the rational choice. Now, ironically, we are actually seeing a real-world example of this play out right now in US tech stocks. So following the release of the Chinese AI model DeepSeek, Nvidia's share price plummeted 18% in a single day due to concerns that a new lower-cost AI model could disrupt the US dominance in the AI sector, potentially reducing the demand for and the profitability of Nvidia's expensive chips. Now, those chips are used to deliver AI to the world. So loss aversion is driving much of the behavior we've seen in that slump, because in reality, no one really knows yet what's going to happen with DeepSeek. They aren't even able to verify the claims of the creators or quantify its future impact on AI. So perhaps DeepSeek's advancements could be positive for AI stocks because we're driving down the cost of AI and increasing consumer adoption, which maybe could be good news for companies exploiting the technology. Who knows? But investors are focusing on the falls and the 18% loss right now and reacting to the news rather than the 200% gain they've made since ChatGPT made its debut in November 2022. So you can see that aversion to loss is dominating their thoughts rather than the money that they've already made. So the strategy to try and avoid loss aversion is perhaps to use things like stop loss orders. So they are automatic alerts if a stock falls beyond a certain value. So it means you can stop watching and worrying about your investments. And so they will fire off if the value falls a certain amount, and that can therefore limit your potential losses and hopefully prevent emotional decision making during market downturns. The other, perhaps more important thing to do is focus on long-term perspectives rather than focusing on short-term market fluctuations. So to put it another way, if you are worried about markets falling, then the best way to mitigate the impact is to actually increase your investment time frame and review your portfolio a bit more regularly. So moving on to the next bias, confirmation bias. Now, this one is prevalent in the investment world, and this is where you seek out information that confirms your existing beliefs while ignoring contradictory evidence. So you imagine if there's an investor who believes in a particular tech company and it's going to be the next big thing, then as an example, they might eagerly read articles about the company's innovative products and growing market share, but conveniently ignore reports about its mounting losses or any competitive threats. So any concerns about the company's valuation or management team that are brought up, they might just be dismissed by the investor as negativity or short seller manipulation. Furthermore, they might primarily follow analysts who are optimistic about the company's prospects while ignoring those who express caution. Now, this confirmation bias can lead to overinvestment in that particular company, in the example I've just given, blinding them to the warning signs and the potential losses that could happen if the company fails to live up to the hype. Now, confirmation bias means that we also tend to more easily recall things that reaffirm our beliefs over those things that don't. Now, if you want to see how we easily fall victim to confirmation bias, there's a really good YouTube video that's called Can You Solve This? We'll put a link to it in the notes of this video. Go and have a watch. And there's a very simple question that the interviewer asks everybody in relation to numbers. And they are all trying to guess what his rule is. And it is a really good example of confirmation bias. And I would suggest that most people who watch it will probably fall foul of the same confirmation bias that everybody in the video does. So do go and watch it, because it's a very good example of how you can fall foul of confirmation bias. But the thing is, confirmation bias is prevalent in mainstream media as well, if you look out for it. So you often see analysts and experts that are wheeled out onto TV programs or quoted in the press that tend to have a similar theme or viewpoint. It might be about AI, it might be about the path of interest rates in the UK. So that means try and find the counter view of what you're looking at. Try and disprove any theory you have. That's the scientific nature, to try and disprove any hypothesis you have, not trying to confirm what you're thinking, try and disprove it and find the holes in that. That is the central point of any investment research I carry out on 80/20 Investor. And the other thing, which is just a bit of fun, is try and spot the confirmation bias in the things that you read and see in the media regarding things like investments. So if you can do that, and you can then see it in other people, you'll see it in yourself, and hopefully you'll be able to challenge your own assumptions. But also do try and acknowledge the limitations of your own knowledge and focus on continuous learning, because you don't know everything. The next bias is anchoring bias. Now, this is the tendency to over-rely on the first piece of information that you receive. That's called the anchor, even if it's irrelevant. So this initial anchor can significantly influence subsequent thoughts and decisions, even when presented with conflicting or more accurate information. So if you want an example of this, and you're thinking about investing, it can mean anchoring on the price at which you bought a fund or share, or it could be the previous valuation of a fund or portfolio the last time that you checked it. So that number then takes an increased importance in your mind and will possibly influence your decisions on whether you sell or keep an investment. Now, anecdotally, I think that anchoring is one of the biggest biases that people struggle with, particularly people who have communicated with me via 80/20 Investor. And that's because they focus on the price of the fund when they bought it and the profit and loss that they have. Now, long-term subscribers will know that I never reference the price at which I buy a fund. Otherwise, just like everyone else, I would inevitably allow my emotions to creep in. Instead, what I do is look at the other investment opportunities out there and compare them to the things that I hold at that moment in time. So that means I don't focus on whether I sell a fund at a loss and move the money into a new investment. I focus on what is the best investment, I think, at that period of time with the information that I have. Now, the next bias I want to talk about is hindsight bias. And this is where you believe past events were predictable. So an investor might claim that they knew something all along when it actually happens, when they look back with the benefit of hindsight. Now, a good example is Brexit. So there may be people who claim that they saw it coming. It was predictable. In reality, it wasn't. It caught most people by surprise. But those people who say they knew all along might now go and make investment choices based on their new perceived ability to predict things like geopolitical events. Another example might be if you go back to early 2020. So when we had the COVID-19 pandemic, stock markets were tumbling, economies were imploding, and somebody may have put a small investment into the stock market against that prevailing fear. Now, following unprecedented monetary and fiscal stimulus across the globe, stock markets rebounded aggressively, which would have quickly seen the investor's small equity investment rally significantly. Now, hindsight bias would lead the investor perhaps to state that it was obvious that stocks would experience this V-shaped recovery and would exceed pre-pandemic levels within a year. They would be boring everyone they ever meet at barbecues or parties to say that they are an absolute genius and they made a killing. Now, this could lead to overconfidence, which is another bias, which impairs their future investment decisions. Because in reality, back in 2020, nobody knew the depth of the pandemic equity slump. They didn't know if it was going to keep going. They didn't know what was going to happen in terms of lockdowns or whether entire economies that had ground to a halt would actually recover, and when we didn't even know, for example, when there was going to be a vaccine developed. Now, obviously, if we go back and we look at things with the benefit of hindsight, it might seem obvious that things turned out the way they did, but in reality, that wasn't obvious. So how can you mitigate this kind of bias? Well, I'm fortunate because I produce an investment newsletter each week that I send out to subscribers. I also review my portfolio every month, and I have to justify any changes that I make. So this means that in the last decade I've been doing that. There's 500 newsletters and 50 portfolio reviews. And as such, that means there's a complete body of work that records every thought I've had and the decisions I've made, as well as the information I had at the time. Now, obviously, anyone watching this isn't going to do that. But what I would suggest is that when you make predictions or you make investment decisions, then do note down why you did that. What were the thought processes that you had, and what sort of information did you have at the time? Then hopefully in the future, it will help you make rational decisions and recognize the unpredictability of events. So I'm going to move on now to herding bias. So it's essentially when you go with the crowd, even if it goes against your own judgment. And it's probably better known as FOMO, so the fear of missing out. So you could have somebody, for example, who is an investor that jumps on meme stocks and cryptocurrency without really understanding the risks because everyone else is apparently doing it. So that raises the interesting question whether momentum investing is just built upon the idea of herding bias. Is it just herding bias in action? Well, it's not. They are fundamentally different things. So herding bias is primarily driven by social factors like that fear of missing out or the assumption that the crowd knows something you don't. So that leads to the irrational behavior of chasing bubbles or maybe panic selling. But in contrast, momentum investing is driven by data and trends. It uses objective data and analysis to identify assets with strong upward price trends based on the rationale that these trends tend to persist for a period of time. So momentum investing can be implemented with a systematic, rule-based approach that incorporates risk management techniques. That's very different to just buying something because somebody down the pub told you that it was a good idea, which is what herding is. So how do you limit the impact of herding bias? Well, stick to an investment strategy. So a plan and understand the investments that you hold and ask yourself the question, are you only thinking about the investment because of what other people are saying or doing? The next bias I've touched upon slightly is overconfidence bias, and that's overestimating your own abilities. So an investor might, with some success trading individual stocks, for example, become overconfident, and they might take riskier bets using leverage on other stocks and ignore the warning signs leading to significant losses. Now, interestingly, Warren Buffett, who is one of the most successful investors of all time, has emphasized the importance of knowing your circle of competence. So the circle of competence refers to areas where you have genuine knowledge and expertise. And Warren Buffett said, know your circle of competence and stick within it. The size of that circle is not very important. Knowing its boundaries, however, is vital. So do make sure you know what your circle of competence is. I know what mine is. I'm not a trader in individual stocks. I'm very good at building portfolios out of funds like unit trusts, ETFs, and investment trusts. I'm not a crypto expert, which is why I don't talk about investing in different types of cryptocurrency. So do make sure that you stick to your circle of competence. I've done that. 80/20 Investor is a beautiful example of that. And I've been incredibly successful with my own 50k portfolio, teaching other people how they can do it too. Final bias is endowment bias. This is where you value something simply because you own it. So that could be an old car, for example. But in investing, you could hold on to shares that you inherited in a struggling company due to the sentimental value of them, despite the fact that the shares are slumping and the company is struggling. So to mitigate endowment bias, you need to evaluate your investments objectively, consider opportunity costs, so other things out there that might be better than what you're holding right now, and separate emotions from financial decisions. So one tip I would say, in order to stop endowment bias impacting my investment decisions, I look at anything I hold and say, if I was looking at this today with new money, would I invest in that particular fund, for example? And if the answer is yes, then it's worth holding. If it's no, then it's worth considering whether to sell that particular fund. In summary, it's not about being a perfectly rational investor, immune to all of these biases. We are human after all, and they are ingrained in us. What matters is actually recognizing when these biases might be influencing our decisions and taking steps to mitigate their impact. By understanding how our minds work and developing a sound investment process and seeking objective advice when we need it, we can improve our decision-making process and hopefully increase our chances of investment success.
Okay, so let's move on to the next piece of the podcast then, and we're talking about crowdfunding this week. Damien, what have we got?
So if you've ever heard of brands like Monzo, Brewdog or Free Trade, you might not actually know that they are well-known companies that started out as smaller enterprises that were funded by ordinary people. Now, this is the power of crowdfunding. So crowdfunding is a way for businesses, charities and individuals to raise money or capital without relying on traditional routes like bank loans or private equity. In this piece, I'm going to explore how crowdfunding works, what the potential rewards are for investors, and also what risks are involved. And I'll also touch upon examples of crowdfunding successes and highlight some of the most popular platforms that are used to facilitate crowdfunding. There are several different types of crowdfunding, each with its own specific features and implications for investors. So equity-based crowdfunding is where you buy shares in a company, giving you a stake in the business. A good example of this would be Monzo, the app-based bank in the UK, which had 4 crowdfunding rounds, one of which famously raised £20 million in just 2 hours and 42 minutes from its customers back in December 2018. If you're looking for the popular platforms out there that facilitate equity-based crowdfunding, they include Crowdcube and Republic. There's also loan-based crowdfunding, and that's normally known as peer-to-peer lending, and it involves lending money to individuals or businesses with the expectation of repayment with interest. However, the P2P market in the UK has shrunk significantly, as has a number of platforms offering peer-to-peer lending. Now, this is because some of the peer-to-peer or P2P lenders decided to stop offering such investments. One of those is Zopa, but there are also a number of high-profile P2P lenders which collapsed, such as Lendy, which imploded in 2019 after an investigation by the UK regulator, the FCA. In fact, IBIS World states that the market size of the peer-to-peer lending platforms in the UK has declined at a compound annual growth rate of minus 19.8% between 2018 and 2023. There still remain a few peer-to-peer lending platforms out there in the UK, which include Cufflink and Easy Money. Now, the other type of crowdfunding you get is donation-based crowdfunding, which is where you donate money without expecting anything in return, often used for charities or personal causes. The most well-known out there, of course, is GoFundMe as a platform which you can then donate to people. And then the other type of crowdfunding is reward-based crowdfunding, and that involves receiving a reward of some kind, like a product or service, in exchange for your contributions. That could be somebody who maybe is trying to record a new record, and they may give you a signed copy as part of your reward-based crowdfunding effort. So popular reward-based crowdfunding sites include Kickstarter and Indiegogo. There is also a subscription-based crowdfunding method where you support a creator on a recurring basis. That's Patreon, which is the most well-known platform out there. So how does crowdfunding work? Well, usually it happens via a website or platform where businesses or individuals pitch their project to attract loans or investments. So these platforms will typically hold the money in separate dedicated bank accounts until the funding target is reached. Now, this is meant to safeguard investors' money. So when you look on the sites, you will find a pitch where a person or entity will explain what they're trying to do, how much money they need, how much they've raised so far, whether it's an equity donation or a reward-based type of crowdfunding, and the length of time the pitch is open for, and also what they'll do with the money that they raise. So what are the potential rewards for crowdfunding? Now, obviously with donation and subscription-based crowdfunding, you aren't looking for a rate of return. You're supporting something you particularly like. But with P2P lending, for example, there's Easy Money, and they quote between 5.4% and 10% target rates. But this isn't necessarily the rate you're going to achieve on your cash, and that's because of a number of reasons. That's cash drag, so there is actually a delay between your money being received and lent out. So that's the cash drag. There's also default. So some people will default on the loans that are made through the platform, and that will reduce your rate of return, and also taxes. But you can technically hold P2P investments within an innovative finance ISA. If we focus on equity-based crowdfunding, because that's what most people are attracted to, the answer is more difficult to discern. So first of all, from a tax perspective, crowdfunding investors can potentially benefit from generous tax reliefs under the Enterprise Investment Scheme, EIS, and the Seed Enterprise Investment Scheme, SEIS. Now, most people don't know that, but it does depend on whether the crowdfunding investment qualifies under those particular schemes. When it comes to actual returns, equity crowdfunding offers quite a landscape of potential successes and failures if you start to do some research. And the rules of the game can change as well, which also impacts your potential returns. So while you may read about some companies like BrewDog that have provided some substantial returns through share buybacks for early crowdfunding investors, such successes aren't typical. Many success stories that you read about online are based upon current valuations, not realised profits from actual share sales or company acquisitions or buyback schemes. They are just paper profits. Now, the timing of any investment that you make is critical, with early investors generally reaping the highest rewards, but they also face the greatest risk given the high failure rate of startups in the early years. Now, a good example of where different crowdfunding investors investing in the same company can get very different outcomes is free trade. So initial investors apparently receive returns of over 300 times what they put in. Now, that's according to some reports online. But those who invested later, prior to a recent sale, so it's just been announced that they are selling to IG this year, have experienced sizable losses. And if you go and look at the Trustpilot reviews for free trade, they are now plagued with angry crowdfunding investors who've lost money, claiming that the company was sold cheaply. The reviews have nothing to do with free trade as an investment platform and its customers and serving them. It's to do with the fallout from the crowdfunding investors who are unhappy about some losses that they're sitting on. The Daily Mail has just run a story quoting someone claiming to have lost £26,200 on their original investment of £30,000. So the other thing you have to bear in mind is that goalposts can also shift. So BrewDog is a good example of that, because a private equity firm, TSG, bought a 22% stake in the company in 2017 after earlier rounds of crowdfunding. Now, the terms of any deals that people make can guarantee returns to the new investor. In this case, it's guaranteed 18% compounded annual returns for TSG. And that could potentially influence the timing or structure of any future IPO or sale, and the outcomes, therefore, for previous crowdfunding investors. So again, you can get a different result than what you thought you were going to get when you went in. Now, what these two examples do is highlight how the ultimate outcome of what you're going to potentially get, even from a successful crowdfunding venture, are going to be dependent on decisions made by other people, mainly the people that run the company and what they want to potentially sell the company for, who they sell stakes to. So there are other risks with crowdfunding. While we're talking about investment risks, you have to realise that crowdfunding is considered a high-risk activity. Now, even P2P lending has seen the FCA place a limit on the investments that people can have. So retail investors who are new to the sector can't have more than 10% of their investable assets in P2P lending. You have to realise that if you're doing equity crowdfunding, most investments are in startup companies, and the majority of these businesses will fail. And if the businesses fail, then the money you invested will be lost. So you've got to be comfortable that you might lose all of the money that you invest. Now, property company Emu, which is or was an online estate agency, collapsed into administration in December 2018. And the collapse came months after the company raised almost £2 million from a crowd-funded effort. So that just illustrates the risks of crowdfunding. It doesn't even guarantee the company will be around 6-12 months after that you put money in. Also, any investment's not protected by the Financial Services Compensation Scheme, so you won't get any compensation if things go wrong. That's actually true of shares more generally. Also, don't forget that shares in small businesses are often unlisted if you've bought them through equity crowdfunding. And this means that you're not going to be able to sell them easily, unlike when you invest in the mainstream stock market. You'll obviously have to have an IPO or the company be bought out by another company for you to get your money out of the investment. There is also the theoretical risk that the crowdfunding platform could fail when they're processing your money, and that's something you have to bear in mind. The other big issue with crowdfunding is that it's heavily influenced by a host of behavioural biases which hinder our ability to make rational decisions. So FOMO, or herding bias, is one of them, and it makes people invest in companies and assets they wouldn't otherwise invest in. Hindsight bias is also one of them. It makes people overconfident because let's say they have a successful investment in equity crowdfunding. They will turn around and say, I knew it was going to be the next big thing. And they overinflate their ability to make a judgment on future investments via crowdfunding. So in summary, crowdfunding is not for everyone. There is upside potential, but there is also plenty of downside potential. But you need to know what you're doing and the risks involved. Don't be blinded by on-paper profits that are often quoted on crowdfunding website, which ultimately want you to invest in crowdfunding investments. So if you do decide to get involved, then do make sure that you're comfortable with what you're investing in, understand it, but you also recognize that if it's an equity-based crowdfunding investment, that you may lose all of your money.
Okay, and so for the final piece of the podcast, I'm just going to quickly mention that it is Financial Planning Week this week. So the CISI, the Chartered Institute for Securities and Investment, highlight a week each year in which people can get access to free financial advice. It is running this week. We'll put a link to that in the show notes and how people can access a free session with a financial planner near them. And so while that's a great initiative, it is only running for 1 week per year. But at Money to the Masses, if you check out our homepage, you'll be able to see that you can get access to a free financial consultation, a financial review all year round. And also, if you want to discuss pensions, there's an option to select the pension option there, and also inheritance tax planning. And not only that, we've put links in the show notes on how you can access the podcast page. And there are further links to lots of other things, including mortgage advice and also life insurance and critical illness cover.
So what you're saying, Andy, is that Money to the Masses gives you access to a financial review for life, not just for Financial Planner Week, which is great. And it's good to reminder for listeners, to be honest, because we are very poor at telling people all of the things that we provide access to. So go onto the homepage, as Andy said, you'll see lots of links on there. We put them on there this week. So Andy, that is it for this week on the podcast. As ever, do make sure you follow us on all our social channels. Wish us a happy birthday. If you are on there this week, you'll see me grinning with that balloon that I talked about at the beginning of the show. So do make sure you follow us. Follow us on YouTube and also like our videos. Join our Facebook group, facebook.com/groups/Money to the Masses. And do make sure you leave us a glowing 5-star review wherever you watch or listen to this podcast. So Andy, I think that's all that's left to say is until next time.
Until next time.